Thanks all for being here. So this is our second Whiskey and Wicks. This week we decided to shift away a bit. Last week, if you noticed, there was a lot more crypto, a lot more people like me. Now we're going to go a bit more professional, get some real alpha for you. So today I have on George Samman and Chris Weston. So let me start by letting them introduce themselves until Grant comes on. How does that sound? Yeah. Chris, if you want to start.
Yeah, hi everyone. Thanks for having me on again. Yeah, look, I've been trading since probably 2001, despite my incredibly youthful-looking looks. So I started at a US bank, and I was trading equities, and then I moved on to fixed income and trading commercial paper from the buy side for Merrill Lynch, and I traded rates just before the commercial paper market blew up. So got a good understanding of how that all worked and how the sort of the plumbing in the system really sort of works together, which I think is something I'm still not an expert by any means, but it gave me a good understanding about how the basics of price of money works. And I started getting into currency trading more openly for the bank, mainly on the hedging side and sort of hedging a lot of the book for the fixed income managers, so the government bond desk, but speculating my own book on the side. And then I got a job as a full-time FX trader for a Swiss bank. So I've been sort of doing that for a while. I've moved over to Australia in 2005, working for a retail derivatives house called IG, and then I've moved over to Pepperstone about 2 years ago, and I run the research desk, really telling people. Everyone says, "Oh, it's about telling people what to buy and to buy what to sell." But for me, my biggest focus is really about how I can get retail to try and price risk and manage risk around key events when they should be in the market, what the market's expecting for certain moves, and more for how they can protect risk, because I think that's the thing that retail do very badly. It's not getting the entry right or what MACD to use or anything like that. It's just really giving people better understandings about what is an event risk and what's not. Things around how position sizing and that sort of factors, which I think are just it's so incredibly important for retail traders and so underutilized. So that's really what I do now. And people can find me on Twitter. You can sort of sign up to my daily notes if you like to cut to my jib. But yeah, so I've really traded all asset classes, both on an institutional basis and also for my own book as well. So yeah, hopefully some of that comes across today.
Yep, that's what we're looking for, Chris. I'll put Chris's Twitter and George's Twitter in the comments here for the attendees if they want to follow. George, you want to give us a little intro about yourself?
Yeah,
I know
thanks.
We all know you and love you, but yeah.
Yeah, thanks. So I guess I'll start with I originally come from a traditional financial background as well. I used to work for a fund in New York before I got involved in crypto, and my main focus was around macro and technical analysis. I did mainly equity trading with futures and options and whatnot. And then around 2011, I got interested in Bitcoin because, funnily enough, one of the technical analysts that I follow, named Bob Prechter, had mentioned it. So I started following it, and it kind of was at a low price and went up to 50, then did a nosedive down to 20. And then started moving again. So it was something on the side that I was watching in a volatile asset. And then around 2012, I became a co-founder of a company that used leverage to go long or short versus Bitcoin exposure, which was called BTC.SX, kind of like what BitMEX does now, but with CFDs. It didn't really work out the way it could have for a variety of reasons. And I left because I came back to New York from Australia, and the bit license and some other stuff really had a bad effect on trading those kind of instruments in the US. So I started to really focus on doing research around the technology itself, started really getting involved in the technology, working with different companies, doing consulting, writing research, doing papers, still trading. As the asset class started to grow, obviously back in the early days, there wasn't as many digital assets as there are now. Ethereum didn't even exist when I first got into the space. So like over the last, I guess it's been quite a while now, 6-7 years, I've been advising, consulting, and designing blockchain strategy and architecture for companies, working with them on all different parts of their business, while still, maintaining an eye and a view of the trading side of things. And recently, I've actually started to get more active in that again, as I've kind of moved away from a lot of the stuff that I had been working on. My website pretty much has like all the stuff that I've done on it. Semantics.com has all the companies that I've worked for, like the papers I've written, my blog, and all that kind of stuff. So I guess like for me, I've always had a two-prong approach on the asset class, which is to understand that like for me, it's the future, and like some of these technologies are going to be around for a long time. They're not going anywhere. They're going to be imprinted in, the financial system, but also from a technology standpoint, they're going to be all different kinds of things, whether they're apps or, just all different sectors and genres. And then the other part of it is using, the trading piece to see, like now that we have like 1,800 different assets, like which ones are real, which ones are moving, and then, also making actionable trades out of those as well. So I always come from like a research first part, and then kind of like trying to employ the stuff that I learned in the past through like technical analysis and market research into the crypto space. And then kind of employ a lot of the same techniques, because I mean, markets are markets, and when humans are trading them, a lot of patterns emerge, and there's a lot of commonalities, not to mention the fact that there is a giant overlap between the macro of the world and what happens in the crypto space. So, those things do matter to a degree. Will they decouple over time? Not sure, but I've always kind of found it, the fascinating piece for me has always been around like the money piece of Bitcoin, the store of value potential, but also this like alternate financial system that can potentially be created that doesn't necessarily need to take over from what we have now, but could be running side by side and competing. So yeah, that's kind of where I'm at.
Yeah, not totally agreed. I mean, I think the most thing I've been seeing lately that kind of is that, yes, we're not a completely uncorrelated asset, as I lived half my time in Bitcoin believing that Bitcoin goes on its own. I mean, looking at the charts right now, you can clearly see that it's just moving along as any stock is. I mean, that's Grant, you're here. Hello, you're on mute.
Yeah.
Welcome,
Can't hear.
Grant.
I think he's still on mute.
He's not on mute, but I can't hear him. Something wrong with his mic.
Right.
Anyways, yeah, let's get into it. I mean, just looking at, first of all, Chris, do you have much exposure into the crypto space? Do you know about it? Do you have much interest in it?
I haven't. I don't follow it that closely, and don't hate me for that, obviously. But,
no, that's fine.
I go back to 2018, and we were offering at my last shop, and I just remember it being just.
Yes.
Are you there, Grant? Can you speak now?
I can. There we go, guys.
So I'll let Grant talk about himself, and then we'll go into that question in a minute. Or maybe not.
You cut out again.
Yeah. Okay. So in 2018, and I just remember it because I'm always really interested in behavioural economics and human behaviour, and I just remember it just being just the mother of all FOMO vehicles. You remember in 2000, going in October 2000, was it 2018 or 2017?
End of 2017. Yeah.
Yeah, and I just remember just going, everyone was in it. It was like, there's one thing that's, there's nothing worse than watching your neighbour get rich. I suppose it's, watching your stepbrother get rich. But that's the kind of situation we had, and we had all these clients who were just making money hand over fist, mainly out of Hong Kong. Saw a lot of business out of the China and Hong Kong. And I just was like, this is just such a brilliant FOMO vehicle. As someone who loves being involved in trends and momentum trading. And when it was going up, I think back then it was probably there was a liquidity angle as well. It wasn't as hard. The futures market hadn't really taken over then. You hadn't got so many institutional players as you do now. But it wasn't very difficult. When it was trending, it was beautifully trending. And I think from a FOMO perspective, when this does go, I think it will go. And the thing for me is, I wrote a piece today, which you can see just released about an hour ago on Twitter about gold. And I'm a big bad believer in gold. And I think, obviously there's a lot of similarities between what I see in the long-term investment case between cryptos. Not so much the technology adoption story, I'll leave that for someone else. But in terms of the macro argument, this is something that George and I can thrash out, to the cows come home tonight, because this is something that I've studied quite a lot recently, is the idea of how does gold not go up? Over a 2-year view, how do I not make money by being long gold, right? And I think you could probably extrapolate that into the Bitcoin space. And, I don't want to go on, so please just, this is a free for all, obviously, but, I was just looking at short term on gold, and we can take my screen, I can have a look at the charts in a moment, but short term, the market's really not sure what to do. And whether I'm looking at the options market, I'm looking at implied volatility, risk reversals, or just the straight technical setup at the moment where gold's sort of trading sideways. If I have a look at an announcement that came out 2 days ago from the US Treasury Department, that they're going to borrow $3 trillion in Q2 and $667 billion in Q3. And I say to myself, right, the budget deficit is going to go out to $4 trillion. And they're not actually investing to grow the economy. They're investing, or they're borrowing money from the debt markets, 6 times more than what we saw in 2008, to pay for putting food on people's tables, to keep people's roofs over people's heads. It's not growth. It's not going to work. It's not going to create inflation. It's not going to create growth. It's just paying for a populist measure. What that's going to do is probably, in my opinion, we're going to get disinflation or deflation over the next 12 months or so.
We're going to get deflation?
Sorry?
Deflation?
I think we're going to see deflation, yeah. There's a lot of people out there who think we're going to see inflation because you see, the velocity of money which has been spiking. You look at M1 or M2 rates, they're just going through the roof at the moment. And if we do see demand coming back on, then the combination of them increases inflation, and that's what some people have been arguing. I take the other view that I don't think this is going to create any demand. I think this is literally to fight a fire. I think wages are going to be cut. And I think you're borrowing from the future to take away from this. I think we're living in a world of diminishing returns in terms of what they can get from this fiscal stimulus. And I just look at the fact that gold trades as a zero coupon bond. So when bond yields are going up, nominal bond yields and specifically real bond yields, inflation adjusted bond yields, gold goes down. And what you end up seeing is a situation where, where's the bond market going to go? And I think that yields across the curve are going lower, personally. And I think we're going to get to a point where if inflation goes into deflation, look, bond yields, you're going to see real bond yields going higher, which is traditionally a bad thing for gold. But that's only because nominal bond yields can't go below zero. They have to change the Fed Act to do that. And I just think what you're going to see is a situation where the Fed's balance sheet continues to just explode. Probably get up to $9 trillion by the end of it, going into next year, and it's not going to achieve anything whatsoever. I think they're going to increase the fiscal deficit. It's not going to achieve much. It's not going to create growth. And we're going to get to a conversation where the markets have to say, well, what does the Fed do now that's going to be something a little bit less or even more taboo? And in all situations where we cause inflation or where we cause deflation, I see a situation where golds go up, and I could speak for about half an hour, but I think gold goes up in all of those situations.
That's kind of how I like, at least me. That's how I like to see Bitcoin, and I know a lot of people do see it the same way. Is that yes, the same way you're thinking about gold is how we think about Bitcoin, and it'll become the asset that people want to hold. George, I'll
just say this just to finish off. Gold and Bitcoin are hedges against what will be next year and throughout this year a ballooning pool of negative yielding debt. It's a hedge against currency debasement from all central banks. Fiat currency is getting debased every day, and by all central banks. Some Kiwis are talking about actually financing the government. The Poms are doing it already. The Fed may do it further down the line. They will not. So you've got all these different reasons to buy gold, buy Bitcoin as a hedge against all of these various factors. And yeah, maybe one of you guys can talk me through the technology argument, because I just see both of those at the moment being a beautiful hedge against all the fucking madness that's going on in the world right now.
George, thoughts on all that?
Yeah, I don't disagree on any of it, really. The only thing that, well, some things to add to that, I guess, are along the lines of negative interest rates. There's starting to be talk of that happening even in the U.S. You're seeing some big economists talking about changing the Fed Act and, the zero lower bound, getting rid of that. There's always been an argument, a theoretical argument from economists around negative interest rates. And the argument goes that you want to have negative interest rates when you have a serious crisis, but you want to have them very deep for a very short period of time. So that's not like what you see in Europe right now, right? Which is like, or Japan, where you're getting like these negative interest rates, but they're really fringe negative. Like they're like 0.8, 0.6, 0.16. The argument is they got to be greater than 3% negative. And at the same time, what you have to do is you have to stop banks from keeping deposits of cash. Like you can't let them keep cash on their balance sheet. So what you do when you do that is you make people go out and invest. And it's not just like investing in risk assets, which is like really what a lot of this has been about, right? Like is that volatility has been super low for a long time across traditional markets. Interest rates have been almost near zero. So everyone who's tried to fight the Fed has lost tremendously because there's only been one place where you could go out and make money in the markets, right? And that's by going out further and further on the risk curve. So what this is all about, though, when we're talking about making interest rates super deep, is you actually go in and you invest in projects, private projects, stuff like that, not just in assets. But the whole entire goal around that is to stimulate and create wealth. The problem with that, though, is that it works for people who have extra income, right? So like we're in a place in the world now where it's about as tenuous as it's ever been, where the disparity is super great. So like what to Chris's point before about like, yes, exactly what the Fed is doing, what the EU or whoever else is printing money, is they're handing it directly to people, but they're handing it directly to people who need that to eat. There's no investment coming out of that money for the most part. The people who have money to invest have been investing, continue to invest. Their assets keep going up in price. I mean, I just saw something today that talked about like the uber rich and where they are 10 years now from 10 years ago. And the amount of wealth that they've made is staggering. But that's not the real issue, right? The real issue really is about everybody else. And there's a real problem there in that, like one of the things that we've always talked about is you had like these taper tantrums, which meant that like anytime the Fed ever hinted over the last 10 years of increasing interest rates, the market would react in a really bad way, and it would fall tremendously because everyone was like wanting to have the risk. Everyone wasn't sure that the market could take it. So it was like a drug for a patient, right? Well, that's what's going to start to happen now too with the money handouts, right? Like how do you get people off of this, and how do you actually motivate the workforce? How do you actually get wealth back into a place where it's more equal? Well, I'm sure like lots of people will take their bread and crumbs and be happy and not have to work and not have to do anything. But how do you get investment back into the economy? And that's really like going to be the big question that I see like over the next 3 to 4 years. It's like one of the things that I look at is like we're in a cycle. We're in a giant cycle, and it probably started around like 2008. And like I follow like cycles a lot, and like I don't know if you guys ever read a book called The Fourth Turning. but it's about like there's four turnings, right? And we entered the fourth turning, which is generally like the time when you have major shifts and major changes. The guy who wrote the book, I really recommend reading it. He goes through American history, and every fourth turning in American history, one was the American Revolution, one was the Civil War, one was the Great Depression, and that the cycle is about 80 years or so, right? And we're into the next one. It really started around like 9/11, but got spurred by the GFC, and now we have the pandemics that's happening, and it's cyclical. And the guy speculates it doesn't end until around 2030. And what you start to see is like these big events that happen, massive protests, dissent, prone to extreme leaders and authoritarianism, and lots of civil unrest. By the end of it, you get like a civic rebirth, a new sense of community, like bigger goals of governance and society.
What was the name? What was the name of the book again?
The book is called The Fourth Turning. But for me, I use it almost as a playbook for a lot of things. One, it follows to a T what's happening in the world, but it also follows to a T kind of the birth of crypto and the thought of like some of the stuff that crypto stands for is like a new monetary system, right? Like Fiat, the end of the Fiat system, which clearly, as Chris said, is coming to an end at one. Trying to predict when, who knows? But we know it's not working. Every single fiat currency is worth less and less every minute of the day. Governance in the democratic world is failing, and there needs to be a resurgence of some kind. And one of the promises around cryptocurrency and Bitcoin is decentralized governance. And one of the things that like I always talk about is like I see that the world is not going to get like it's not going to be bigger in the sense of these giant conglomerations. I think you're going to see more and more states over the next 10 years than you have ever before. And not only that, like you'll see more and more self-governance or governance happening in ways that are really creative that are undermining or not undermining, but are directly competitive to the governments we have because people are fed up and they can govern themselves probably better than the governments can for them in a lot of cases. The EuroZone's a disaster area. And, just the other day, Germany basically was like, well, we're going to kind of like, we're not accepting this stuff. You need to propose to us, anything out of the ECB in order to get it accepted through. Like countries don't even, at least with the US, like you have your own reserve currency, you can print if you want. Italy can't do that. Greece can't do that. France can't do that. Germany can't do that, even though they dictate everything. It's not going to work, especially now in this situation in a pandemic where people can't even control their own policies monetarily. Like you can't have you can't have fiscal integration without economic and social integration. You don't have that. I don't see how it's going to last.
Point on just interrupt.
No, it's all good.
The point on Europe's a really interesting one because, we haven't had a situation where people are really genuinely concerned about political unrest. We've always said that if we see a massive recession, then Italy's one that could have big populist movements that could come through. As a result, we've seen that with political issues with Italy pretty much every week. But the German thing's really interesting. We've been following it fairly closely. So they created an asset purchase program called the PSPP. The German Constitutional Court said that that's unconstitutional because the weightings for what they're buying is not right and it's favouring other countries. Now, the concern we've got is that the new program that they've created a couple of weeks ago called the PEPP, which is the Pandemic Emergency Purchasing whatever piece. Right. Basically, the idea here is that there's 750 billion euros in that to go and help credit and liquidity and various factors, which is what central banks do. They provide liquidity. They do a very good job. They don't spend. They're not doing proper MMT, but they maybe one day they will, and that's where your big kicker is for Bitcoin and gold. But the legislation here is the Bundesbank now have three months to sort themselves out and try and convince the German Constitutional Court that the previous asset purchase program was actually legal. There's a good chance they won't. in which case we're genuinely concerned that this new program that they've created, the German Constitutional Court will say that's actually illegal as well. And that's a big problem. That actually makes the EuroZone a big problem. It makes the EuroZone a problem because the biggest creditor nation is moving away from Europe, right? And it makes the whole policy, we're not sure how that's going to work. This emergency fund, which was supposed to be distributed out to everyone, we're not even sure if that's going to work. So if you've looked at the currency markets the last couple of days, you know, we've been saying to everyone, look at euro yen. We've been advising people to go out and sell euro NOK. Can I take the screen quickly?
Yeah,
feel
share
free.
screen.
Exactly right. The currency markets are, especially the euro. The euro has been challenged lately, and exactly why.
Let me just start this. So if you have a look at euro yen, so the yen's we always like the yen in periods of high vol and risk aversion. But look at the price action that we've seen here. So we've got these lows. You know, you've got markets, these big. Let's put it on a candle chart. Probably prefers candle charts, but you can see here that we've just got this massive gap down. So we'll wait for the close through there tonight, and you're going to see, you know, you're in blue sky territory really, or the reverse of blue sky territory. We're coming down into this 110 region. So euro yen looks absolutely lovely. I mean, we can talk about oil, but you know, for me as a currency trader, I always think big picture and then hone it down into the technical side of things. And I'm thinking right now, I think people are feeling better about the oil market. You know, how do I express a view in the oil market through currencies? Well, I go to the Canadian dollar, I go to the Mexican peso, and I go to the NOK as well, because the Norwegians are big exporters of Brent. And you can see here that we've got this just absolutely, just got this lovely little move through here. So if you, obviously we've got this trend low, but we've broken this sort of series of lower highs. And I think if you're going to see Brent prices move up a little bit higher, this is going to break through there and through this kind of level here, 1103, and I think we're going to trend nicely lower. This is when you start getting the trending money, the CTAs, if it starts to sort of hold below the 5-day exponential moving average, and you found this kind of impulsive.
On that, Chris, have you guys also looked at? I was reading, you know, there's a lot of articles out recently, obviously when equities are at their lows, and now it's probably a bit different, but essentially the Norwegian sovereign wealth was going to actually have to start selling assets. So if it's doing that, is that then also positive for NOK because it's a repatriation play?
Yeah, I haven't been followed them closely enough to see what they were doing in terms of selling assets.
I think it was the first time since basically inception, or certainly for many years, that the fund this year will be net down. Yeah. Like not in return sense, but in actually that they have to actually liquidate assets to meet the requirements of the actual government, which is obviously what the fund exists to do. But yeah, I think it was like down by about $6 billion US. But you can think about the ongoing income that fund, you know, is taking in, and all those other things. So if you back it out, it's net $6 billion US down. But that's then you got to probably put on it, you know, if it's yielding 5% on 150 billion. That's still, you know, a lot of extra as well. So it's, you know, essentially they've had the government's like, you know, dipped in for, you know, 30 billion US or something like that.
Well, I can't imagine they're the only government who are in a bit of a play. But for me, what's also really important there, Grant, is what they do in terms of production. So for me, I was looking at, you know, obviously what the shale gas guys are doing, and we're now seeing a response. So there, obviously, you've seen the rig count coming down pretty sharply. You've seen a number of companies talking about cutting back production. The Saudis are rumored to be talking about exporting about 6 million barrels a day through April, which is the lowest we've seen for a long time. And the Norwegians themselves were talking about cutting back on production. I can't remember how much. So it wasn't about those selling assets, which you know, something maybe you've been looking at. But for me, it was about what are they going to do in terms of production, and then we can get this sort of clearer idea about what was going on in supply-demand imbalance. But as with anything, you know, it's what price does. And you know, for a large period of times, you can see that the euro was doing really nicely because the euro works really well as, in times of high vol. In high volatility, you see the funding currencies working really well in FX markets. You know, the yen, the Swiss franc, and the euro to an extent, and you know, obviously the high carry currencies coming under pressure. But that's not true now. Now you're seeing a situation where, you know, obviously oil markets have had a nice bounce. There's been a slight, the contango's come out of the market a little bit. And, you know, obviously equity markets are doing nicely, and we've seen a lot of volatility coming out of the markets to an extent. So, you know, you're seeing some of those funding currencies coming unwound. So I think with Euro, you've got exceptionally low growth, some creeping up of political risk. You've got a fractured situation, which George talked about. And now you're seeing, you know, the markets of, you know, volatility is coming out. So why would you want to be long funding currency? So, you know, for me, these are all the sort of factors that I look for. And then I look at the charts and understand, you know, is the flow of capital moving in that way? And when you can sort of get your technical and your macro thing together, then, you know, you can make a short-term play, because, you know, you're trading highly leveraged products. You want to make sure you're trading in direction of the capital.
So how does all this affect us as Australia?
Well, I mean, look, for me, how does it affect us as Australia as an economy? I mean, we'll bring.
I mean, let me take my point of thinking. I mean, I think it's a lot of questions. A lot of people are asking, even again at the retail level, at least. I mean, our dollar is becoming essentially useless. I get my salary and buy half the things I used to buy last year just because I like buying things from the US. How long does that continue for? What's the drivers behind that? I mean, surely with the US printing money, are we printing as much money as them? How's that happening? How's that balance?
Well, we're not printing as much money as them. In terms of absolute balance sheet size, then we're not. As a percentage of GDP, we're not. Our fiscal program as a percentage of GDP isn't as big. And actually, I think I could bring up some of the charts, and maybe I'll do that when one of the other guys is talking, but the excess cash that we've got in the system has actually been coming down. It was about 85 billion a couple of days ago. It's come back, or a couple of weeks ago, and it's come back down to about 65. So excess cash that's been held by the commercial banks on the balance sheet of the RBA has been coming down. But to be honest, you know, like, I look at correlations very closely in markets. I want to know why something's going from A to B. Is it internal? Is it something about the Australian economy? Is it something to do with what the RBA are saying? Or has it got a close correlation with another asset class or another market?
Okay, guys, I have a question from one of the lists.
Let me just add something in there real quick to that. The other major problem is it's basically all currencies versus the US dollar, and there's a dollar shortage, and that is actually causing for everything versus the US dollar to go down versus USD. And, you know, we could talk about that later, but this is one of the major themes that a lot of people are starting to talk about globally, is that there is a massive shortage of dollars, which is destroying lots of economies, especially emerging markets, but everything's priced, you know, Euro, Aussie USD obviously is going to go down as the US dollar gets stronger, and every other currency is going to have the same problems. And you know, that's something also that's probably starting to emerge as one of the bigger macro patterns that people are talking about. You might have seen it, like Pomp had someone from Santiago Capital on, and he calls it the dollar milkshake theory, talking about how the dollar is basically you know, it's like, have you ever seen the movie There Will Be Blood? When he talks about drainage, everything else is getting sucked out from one side of he's able to get all the oil from other people by, you know, putting a straw there and sucking it all out to his own. And that's kind of what's happening with the US dollar. That's why you're seeing like all these swap lines starting to open for people to borrow versus the Fed for enormous amounts of money, like the Bank of Indonesia, Singapore, and whatnot. It's a real problem. That might have been the thing, like, they were talking about the canary in the coal mine back in September, when the repo markets had that major dislocation, and people were starting to speculate maybe that's the end of the bull market. But that was really a liquidity problem, and that's what's going to happen again if the dollar shortage gets worse and worse. Even China is starting to run out of US dollars.
Let me just quickly bring up. Let me just bring up this one chart, and I just can you see? Hang on. Which one can you see? Can you see the blue and the white line?
Yeah, we got that, Matt.
Yeah.
So what we see here is the blue line here is the Aussie dollar, and this is the S&P 500. So yeah, right now they're just moving lockstep. So what's driving that? That's Fed liquidity. You know, the Fed liquidity is the reason why the equity market's where it is right now. It's nothing to do with economics for sure. Okay, son, you've got a little bit to do with, you know, economies opening up, but it's not looking inwards. It's not looking at the Australian economy. It's not looking at what the RBA are doing. You know,
Are you able?
Where the S&P is going, and I'll tell you where the Australian dollar's going at the moment.
Are you able to put the Bitcoin chart on top of that?
Yeah.
It'll be trending exactly the same way.
Yeah.
Yeah, because it looks. I'm looking at it. It looks very similar to that chart.
Can anybody hear me?
Yeah,
Flynn,
mate.
Flynn, you're on. Sorry, mate. I just put you on, and we got into the chart. Guys, Flynn's from the viewers, and he has a question or comment, I think.
My question is, do you think that Bitcoin will become the new gold standard?
I think George.
I think it will be complementary to gold and potentially will be like I don't look at things in extremes because too many things happen in the world where you think something's going to happen, but like
no definites in finance.
Yeah, no definites in finance. I mean, because you know, like everyone's been pining on for a while, like that the party's going to be over, and you know, the party does. I think it has a chance to. I think like when you start to take that seriously is when it starts to approach the market cap of gold. Right now, like, you know, there's lots of positive qualities that it has, and then some other ones that it has that gold doesn't have. But I think there's a possibility that it could, yes, for sure. I mean,
yeah, I believe so myself.
Yeah.
Chris?
Yeah, I don't have a strong view on Bitcoin there. I mean, I don't think we're going to go. I don't think we're going to see a return to the gold standard anytime soon. Not something.
No, I mean gold standard in reference to the gold price being the safe haven asset. I suppose that's what I mean.
Yeah, look, I think that there's going to be, like, as I said before, I think Bitcoin, I think gold goes higher, and I think people will want more gold. If we ever get to a point, the thing you need to think about, Flynn, is the point where we get to a point where nothing really works. You know, the deficits continue going higher and higher and higher. We're getting no growth from it. We might get stagflation. Central bank action.
We're in stagflation. Yeah.
And then we need to start thinking about changes to the Fed's mandate. If you actually ever were to get proper MMT, where I'm talking about funding governments, the Kiwis are talking about it, that the British are already doing it. If the Fed were ever to go and change the mandate and actually start spending, which you actually start talking about hyperinflation longer term, people want real assets. They'll go out and get Bitcoin. They'll want gold. They'll be the places you want. And we're not.
Are you saying that they will want Bitcoin?
Yes, I do. I think Bitcoin and gold will be exactly the same.
No, I think they will go hand in hand.
Exactly. I think we all agree there. I mean, obviously, I hope it doesn't happen because I think the world will look pretty dark if that happens.
Couldn't agree more. Be careful what you wish for, right?
Yeah. I don't want to see a situation where the Fed have to change their mandate and go down the MMT route, But if we were to ever go down that route, which I'm not saying it's not going to happen, then people want real assets. People want commodities. You know, people want hard assets, and Bitcoin and gold will be considered hard assets in that situation.
Well, in the modern era, you could argue that Bitcoin itself is an intrinsic product.
Yes.
Yep. Ron, what do you think, mate?
Yeah, I'm with you, Chris. I've been saying this for a long time. Omar can tell you this. Like, I think I said actually on last fortnight's. I think real assets is definitely the play here. I think anything that generates actually real hard value is going to be more and more valued by investors more and more greatly. I'm coming around to thinking we do have a more deflationary than inflationary problem on our hands, and under that aspect, financial assets or financial engineered assets go nowhere. You know, it's going to be, as you said, assets that actually generate out real growth or real items or goods that people want.
Lean hogs.
the
Yeah, exactly. Like, mate, I've been telling lean hogs for a long time. As I said, you can always take delivery.
That's
You know, so
the three of you seem to be in agreement on the deflationary fact. Now, excuse my naivety, I guess, but I mean, why are you guys keep talking about going deflationary? I mean, aren't we printing more money? Isn't that by definition inflation?
No,
inflationary. That's what I believe.
You can't have real inflation unless you have wage growth. How can you have wage growth in a time when unemployment is at record highs? It's going to be certainly deflationary right now.
Even though we're printing more money?
Yeah,
yes.
because no one's taking up the slack on it.
There's no real demand.
Yeah, exactly. You're printing more money, but no one's
actually using it to spend.
Exactly. So you think
the
about
fundamentals aren't there.
Yeah, the great inflationary periods of history is like, you know, the Weimar Republic in Germany, right? That's the one everyone trots
The
it.
Wehrmacht.
And you used to have to turn up with your wheelbarrow of cash in the morning just to get a loaf of bread. And then by the end of the day, you need 2 wheelbarrows. Well,
but essentially that makes the currency stronger, right?
No, that's you know, you're eroding it. You're eroding it massively. But that was happening because of that people were still out there, and there was legitimately, like, most people were still actually trying to it was just out of control, and it was just happening from the point of view that there was no tether or no backing of anything of actually what was going on. Whereas now at the moment we can come out, we can print a whole bunch of extra money, but it's actually just washing around really is in the ledgers of the banking system, and it's actually not translating, which is what Chris is saying about monetary MMT, is if it actually leaves that financial system, actually gets into the real economy, then you do have inflation, aka not the Fed not buying some not made up, but some paper junk bonds, but actually going out and building a bridge, then that's inflationary. But we don't have that at the moment. So essentially we've just got, as George said, we've got this hugely weak demand side of the equation. We've got this supply side that's just sort of sitting still over here. And whilst that demand side's weak, you can't get inflation.
And that's really the issue with deflation. And basically the Fed, the central banks of the world that's all they've cared about and focus on is deflation this whole entire time. And the reason why is because it's a spiral, and it's a demand side spiral that they don't want ever to get into, which is that when the demand goes away, and diminishes, it's really hard to come back from. But what always happens in deflation is followed by inflation. But at first you get these deflationary periods. Like if you look around the world right now, right, prices of real goods are up over time. But the problem is with the numbers that they use for whatever inflation is that they can change what's in the basket of inflation. And they do that all the time. So lots of things get left out. But now you're seeing for the first time probably in a long time, like even here in Australia, like rents are starting to come down in price. And
that takes to my second question.
But that's only part of it. Like I want to see if like food prices and start to come down in price and stuff like that.
Before I get into the property talk, Chris, a question from someone in the crowd. So what he's asking is, he's saying he has an X amount of Australian pesos, nice one, X amount of Australian dollars at the moment, and the person is holding that to make a home deposit because he's looking to buy a house. Now, what he's saying is, would it be smart to change that AUD into USD and hold it from USD for a few months? Or would the smarter thing to be, by the way, before he answers this, everyone's not financial advice. This is just us talking. It's not
general advice.
Yeah, it's just us talking. There's no financial advice here. Yeah. So what do you think, Chris? Would you want to hold USD right now? Would you stay in AUD? What are your thoughts on that?
I've never got any problems with holding USD, to be honest. I think in the Santiago Brent Johnson Smile situation is always one that I know Brent and his views there as well. I mean, if we saw equity markets roll over, if we saw implied volatility kicking up, mate, the dollar's going to rally. There's no doubt about that in my mind. We've seen the Fed, like George mentioned, about the swap lines and offering repos for US Treasuries, and that was a very, very smart move from the Fed to do. Kept their reserve status very firm. It kept emerging market capital in the US. But until you see a situation where relative growth rates around the world becomes stronger and more compelling, you are going to see the US dollar continue to be firm. When we talk about the US dollar, when we're talking about the trade-weighted US dollar, we have about an 80% 20-day correlation coefficient with the dollar index. So, you know, the dollar index, the Dixie, is 57% weighted towards the euro dollar. But the trade-weighted dollar, which is, of course, is the one that everyone focuses on, or the Fed focus on, and it's, you know, what the US economical system will focus on, has a very strong correlation with the dollar index, which is then 57% of the euro. So the euro matters. What on earth would you want to be involved in the euro? There's just no point in having any money in the eurozone. So the dollar will continue to be strong, in my opinion, until we see the world coming out of this situation, if we ever see the world coming out of this situation, and we see relative growth rates in other countries, and people want their money out of that. The irony of the whole situation right now, for me, is everyone says to me, Chris, you know, the Fed are really aggressive in expanding their balance sheet. The central, you know, the government are doing a bigger fiscal policy as a percentage of their GDP against most countries. But you know what? Rather than actually take your money out of dollars like we did in 2008, because the Fed were the only one going down QE, the irony now is that investors want to be involved in the US system because the Fed are actually trying to do what they can to try and promote a stronger economy, and it's actually boosting risk assets as well. So, you know, if the Fed were doing this idiosyncratic, then the dollar would be getting smashed. But they're not, and everyone's doing it, and people want to be involved in places where, you know, it's the shiniest house at the moment. So, yeah, I can't see the dollar weakening.
Okay, no, that's fair. That's kind of what I had in mind. I kind of don't think the US dollar is going to be weakening anytime soon, but
just going back to the viewer's question. But my view is, if you're ever looking, because, you know, predicting currency markets over the next 2 months is you know, it's not what we do as traders, right? You know, we react to price moves.
It's a month's game.
You don't trade 5-minute charts?
Yeah. Well, so what I would do in this situation is I tell people, if you want to go, if you've got a decent holding, you know, you're not going on holiday where you're going to talk about a couple of grand. If you've actually got a decent amount of capital and you are genuinely sensitive to currency moves, just lock in half, and then the other half you can fuck around with later on in time. But at least you've got certainty. So I would always, you know, if you worry, because the Aussie dollar could roll over, and going back to my chart, if the equity markets roll over, the Aussie dollar is going to go down with it. The US dollar is going to strengthen. If the US markets continue going higher, the Aussie dollar is going to strengthen as well. So
essentially, dollar cost average into
half, and then you've got at least some certainty, you know. And then you make something big. Okay.
Flynn, thanks for coming on. I'm getting. So Cloud Juice is here. So
two from Juice.
Yeah, Juice is actually, he started off as an FX trader we had him last week. He has 2 questions, and yeah, let's bring Juice on. Sir Juice.
Yo.
How are you, buddy?
Good. How are you guys?
Mate, good. Any of those ominous tankers been on the horizon this week, bro?
Oh, got to keep quiet.
Just
on
before,
that, hey.
before I let you ask your question, are we longing or shorting Bitcoin?
I'm short, but I'm obviously 100% spot.
Yeah, just wanted to clarify for that. Okay, let's get back. So Juice was asking about property, and I'm personally actually interested to hear about this. So go ahead, Juice. You can feel free to ask.
Like, where do you see property in all this? You know, everything else has dropped, yet property hasn't really. Yeah, I like that. I like where that finger's headed.
I recommend, like, if you want to get a really good take on it, there's this guy on Twitter called Avid Commentator, and he's been putting out some really solid pieces about the property market lately. And his take is obviously that it's bearish, and it's based on, you know, all the global events that are happening. And he puts a spin on it he's Australian, so it's the Australian market. But yeah, he's pretty bearish. He sees 20 to 30% to the downside.
Is this over
20
years?
to 30%.
That's really good. I just make a case. Let's just remove the fact that property's not going to go up. and that's bad, because we don't want that to happen. We want property to go up. Everyone feels wealthy. The economy strengthens. But loads of people are losing their jobs. I know we're on job seekers and all that kind of stuff situation, but there's no doubt in my mind that the savings rate in Australia is going to go up very, very strongly. People are going to cut back, and people are just not going to buy houses, and that demand is going to come out of the market. I think you've got to worry about how bad the economy gets. They're talking double-digit declines in GDP. Whether we get that U shape or an L shape, I think we're going probably more. I think we need to discuss an L, maybe a W shape recovery. And I think all those factors tell me that the property's going down. I can't see it, going sideways or up. I think it's going down. The question is how far it goes down.
Yeah. So obviously you're not going to be jumping into buying something right now.
I'm not. No.
Like the problem here is the economy, the real economy is lagging behind like the economic stimulus and the markets, right? Like we still don't even know what's going to happen here from a real economy standpoint. Like the shock is just so close. It only happened less than 2 months ago. So like the fallout is only still starting to happen, and we still haven't even no one except for China has come out of COVID yet. So like the lag is going to be pretty real and pretty deep, I think. It's just
these guys have got to get it right as well. Some government, they're going to roll off. They're going to roll off the restrictions. They're going to then roll off job seekers and all the other stimulatory measures. And if they don't just snap it and get it completely right, there's going to be some real big problems again.
It's going to be fucked.
So it's not we trust and Josh Frydenberg and hope that these guys get it right. Otherwise, it could go bad. I mean, obviously, I don't hope that to happen. I don't want to be a doomsday spooker at all. But yeah, I think we just got to think that property is a pretty simple game. I think when we come to asset classes around the world, property seems to be as simple as it comes. It's a confidence game. If there's not a lot of property necessarily getting built, but if you don't feel comfortable about yourself, your own personal situation, you're not buying anything. And then you've got to worry about whether the banks are going to be lending to people as well. And I think credit's going to be hard to get hold of people.
So that's the other part. I think it's more the mentality of things. I mean, when I first got into Bitcoin in the early days, and eventually I made some money, the first thing my parents kept hounding me on was, you need to buy property. If you don't own a home, you don't own shit. And in my mind, that wasn't true. I eventually caved in and bought property because they made me do it. But even right now, if I think about buying property, I don't look at buying a home. I'd want to buy property that I can rent out and as an investment property. It's not really I can rent my home. I'm not interested in living in it.
Yeah.
How does that, nowadays I can't even rent. I mean,
Airbnb is effectually banned as well in New South Wales. So like, that's going to hurt the property market as well. Because how many people have bought properties that they were going to Airbnb for much higher than rent, but now they can't even do that. So like
they can't even rent them right now.
How are they going to pay back principal? Like,
and even people renting. I mean, when the government tells you that, if you can't pay your rent, I mean, they're not telling you don't pay your rent, but it's very hard to enforce somebody to pay your rent right now. And assuming this doesn't go away next week, that's going to cause a lot of property investors are investors. That's what they are. It's not homes. And a lot of these people are going to get very hardly affected and have to sell because the business is hemorrhaging money.
Yeah. Well, we should wait. Let's wait. When the Fed starts buying houses, then we're good to go. I reckon. Should be fine.
Well, that's funny because like they've already been talking about that, right? Like even here in Australia, I read something about like, they might start buying coal mines to combat climate change, right? Like everyone's talking about like, buying anything and everything that they can just to like try and fix the situation. And it's just like, it's unprecedented what's coming out of people's mouths. Like we're living in the time of anything is possible. So when you're living in times like that, like you can't rule out anything, and you have to be very nimble in like how you invest and how you see the world. Like, because like Chris said before, a lot of it is psychological, whether it's property markets or any other market. Like if people start believing MMT is going to work, it can work, or at least it can work for a while. And you can get buy-in and like things can go up as a result of it or anything, right? So like, it's like suspension of belief, of disbelief.
I read something
to a point now where like no one knows what's real and what's not real anymore.
Something interesting I watched on a show, and the guy was saying is like, but the numbers, it's a trading show, and they were looking at the market and they're like, the numbers are wrong. The other guy looked at him and was like, markets aren't about numbers. It's about men and their emotions and their superstitions. That's what changes markets. And that's the reality. People fear bearish. It's going to stay bearish. And people
Price
want
is the only thing that matters.
Yeah.
That's it.
But you also, coming back to your point there, George, as well, like the way that, you know, that someone wants, that the societies want to accept it is the way that things play out. You look at Japan post, you know, their blow up in the late 80s and the early 90s. They had huge deflation. They had zombie companies now that still exist. There's still some 30-year-old zombie Japanese companies, but essentially the culture was you don't write off bad debts, you don't push people out on the street, and you continue just to everyone sort of save face and walk around and just, you know, be happy with not much growth. They've had 30 years of that, and everything for them is like it never fell off a cliff. This is the other bizarre thing about, you can have these bizarre deflationary things where you can essentially just lose a whole generation.
Exactly.
And if the wealth that's built up in a lot of Western economies is still relatively very high, and obviously, yes, gotten more concentrated, which is going to be an issue, but that wealth can last for a long time. And that's what we could potentially just see. We could just see an erosion or a spending of the world's accumulated wealth that essentially was a generational transfer to this generation from future generations anyway. Like Druckenmiller writes a lot on that. And I think that's just what we're going to start to see. So we just start to see that just get played out, and we just sort of limp along potentially for a long time.
You know, Grant, you bring up a great point, right? And I wrote in the gold piece today that the US, every central bank is absolutely shit scared of Japanification. You know, they don't want to be Japan. No one wants to be Japan. And demographics are changing. The population growth is falling. But the US is going exactly the same way as Japan. Well, there's no doubt in my mind that the government debt to GDP levels are going, they're not 250% like they are in Japan, but this year they'll be 130%. They're 110%, 105% last year. That debt to GDP level will go up and up and up, which is why we start getting diminishing returns from what they stimulate, and it fails to produce the levels of growth that they would have done had debt to GDP levels been around 50% where they were a number of years ago. But if you look at where the demographics are, the population growth, the aging population, if you have a look at the, what's going on debt to GDP levels, the deficit, the need to fund that deficit, and then you've basically got a central bank who are keeping yields low to make sure that that they can actually repay this, and it's not going to be a massive burden on them. I think that the US are going exactly the same way as Japan. I think Europe are going exactly the same way as Japan, and that's the way that the world will be in 15 years' time. Is a model of what Japan looks like. I think is where we're inevitably heading in my opinion.
Yeah, and so that's just a super interesting. That's a super interesting point you bring up, because like a lot of the great thinkers out there have been kind of positing for a while that there hasn't been real growth for 30 or 40 years, and like the one thing that people are starting to say, and say it more open than they had in the past, is like there's no guarantee that there has to be growth. Like we can have quote unquote middle ages or dark ages where nothing happens for quite a long time before like growth comes back. Like and that could be a period that we head into for a while here until there's some kind of like technical.
Bank of Japan own what? 80% of the ETF market.
Yeah.
That's it.
All the bonds.
And are they
Isn't that manipulation at its finest?
Yeah. You just don't accept it to go down. You just hold it there forever. And who cares?
The next thing the Fed will do, and it might not happen straight away, but it might take a couple of months, the Fed will go down yield curve control. So yield curve control obviously being different from traditional quantitative easing. Quantitative easing, people are watching, is you're actually quantifying the amount that you're buying every month. The Fed started with 85 billion in March, 85 billion worth of mortgage-backed securities and US Treasuries a day. They're coming back to about 8 billion, I think, at the last read. Still a decent clip. But with yield curve control, what they do is they're actually just specifying how the yield curve looks like, and they'll buy unlimited amounts. They're not actually quantifying an amount to keep that, or manipulating the yield curve. How do I continue to be a fixed income strategist for a US bank? I would have lost my job. There is no need for a fixed income strategist in an environment where you've got yield curve control, because it's fucking, exactly where the yield curve is going to be at any given time.
And that's in the US.
In the US, but they're doing that to
the free market,
where they're saying that we're going to keep the The 3-year below 25 basis points, and they've done a very great, to the RBA's credit, they've done a fantastic job. The 3-year Australian government bond is below 25 basis points, and they've bought less bonds. The market is respecting that. That's the great thing with with yield curve control, is you don't have to keep buying bonds every day. Like with QE, you are buying that amount of bonds every day. With yield curve control, you're saying if there's a deflation or a disinflationary mindset and people are going out and buying bonds, you don't need to do that. All you're doing is you're capping it, and that's where you don't fight the central bank. So that will probably be what the Fed do next. And
that's like, and that in and of itself is like the biggest problem in the world right now, right? Like Christopher Cole from Artemis Capital talks about this a lot. Like volatility suppression that we've seen leads to bigger volatility events when things blow up, and like all this stuff that they keep doing is trying to stabilize, keep everything, like basically bail out everything, keep the world at bay. But it just leads to these massive volatility explosions, which disallocate from the fact, which are just disallocations of capital that have been misused and abused, but also just suppression of the curve and the stability that they try and maintain. It causes more instability than stability over time. It goes right for a long time, but then it explodes and it just causes these severe consequences.
The other weird thing is what it's done, George, is it's created the second order effect that so many of the quant funds now trade on low vol as a positive trend sign. So when you suppress vol, they get longer and longer.
Exactly.
And as they get longer, vol gets suppressed further, and then so the signal just becomes just a friggin' virtuous cycle, right? 100%. And then, as you said, and then at the top, no one wants to be long.
No, and the funny thing is, you always think like these quant funds are going to be like, they're going to make the most money when volatility comes back into the market. Actually, they get fucking destroyed because they're the low vol trade, right? Like so.
So we were looking at the S&P, and you've got the S&P was obviously collapsed, and you had years of low vol structures coming out of the market. People were selling puts above the market and getting income, and pension funds were basically getting additional yield enhancement by selling calls above the market and getting that premium, and then obviously buying deep out the money puts as a hedge. And I think ultimately now the market's been pushed up by CTAs, trend followers, and systematic players. What would cause it to go up to the next level would be your vol targeting funds. So the vol targeting funds, they need a VIX below 20%. They're not in the market at the moment. You've got different levels of vol targeting funds, 10%, 20%, whatever it's going to be. But what would cause the S&P to go to new highs would be
VIX at 14,
and it would be the VIX.
Bugger off.
So I look at the VIX all the time. It's because implied volatility in markets is it's not only incredibly important for you to understand what the market's anticipating for movement, which you can use really, really, very, very well for position sizing. I use it all the time. I look at strangles and straddles to understand for my spot trading. If you can understand what the market's implying over a day, overnight straddles, or weekly straddles, I can use for my swing trading. I can understand if the market's anticipating this. You can use that to understand how much risk you're taking on, and then your position sizing as well. So, I think volatility, implied volatility, is something that I use as part of my process. It's part of my risk management and my money management assessment. Absolutely. If anyone's out there and wants to know more about implied volatility, you can use it really, really effectively for spot FX trading. You probably could use it for Bitcoin trading. I don't know. I haven't looked at.
No, you're absolutely right there, Chris. I think, by the way, I only learned the biggest thing that people mess up with in crypto and all crypto traders is a lot of the big crypto traders, especially, we all got massive bags just because we got in early, which is fair enough. We deserve that for believing early, but we're not professional traders. And the biggest mistake I see everybody do, and it did not make me a profitable trader until I learned it, was risk management. That's it. Just the concept that every trade, you need to know the risk you're taking on. You need to understand how much risk you're willing to take on. And I think that's,
well, also, to be fair though, like a lot of the sophisticated tools, well, I wouldn't say a lot, but the sophisticated tools that you're starting to see now in crypto didn't exist until very recently.
Well, that's also very true. Yeah,
you
that's
couldn't
right.
write covered calls against your spot long, like if you want to protect and hedge.
on my digital.
There wasn't a lot of hedge. That's it. Now you can. Now you can. Like, this didn't exist for a long time. Like you could.
You're right. Yeah.
The only thing you had was like CFDs, long, short, fucking 100x, blow up, or no matter what you do. Like now the market's starting to mature a bit, getting there. Like really good products coming in. Still some liquidity issues around a lot of them, but you're seeing some innovation too in that side of it. But you're absolutely right, Chris. Like you can certainly use those things in the Bitcoin market now too. And I mean, there's the CME futures and there's like Deribit and
here we go. This is the typical crypto trader.
No, that's not the typical. Most of them don't have the cojones to be that type of trader. Yeah. That's my type of trader.
Yeah.
There's the hedge into Silk Road label. The other question was for George quickly. Oh, sorry. Where do stable coins fit into all this?
Well, I'd say that like there's a couple things you can look at with stable coins. One, like they're a leading indicator of the market in some ways. Like so as we've seen recently, there's been about $8 or $9 billion put into stable coins, USD backed stable coins, and a lot of that's been moving to exchange, which is presumably meaning that it's going back into crypto. But like the main point to take out of it is that people are taking money in and out of crypto and not changing it back into their bank accounts or into actual paper or fiat dollars. They're leaving it in stable coins. So the stablecoin market right now is a really robust indicator of money that's probably looking to be redeployed into the crypto markets. The one thing I'd say, though, about stablecoins, and this is something that I think is a challenge going forward and kind of interesting. Like I got asked this by the Block a while back. Like if we go into a negative interest rate environment or an environment where rates are really low, a lot of these stablecoin companies probably go out of business because they can't make money when there's no interest rate, right? So like they need to I guess what I'm trying to say is I think it serves a purpose for now, but over time into the future to be determined how big it's going to stay in the crypto space.
2 points on that, George. I think the one you said on the negative rates I think is interesting. I think the way that let's be honest, like obviously Tether are doing this already. They do that because they're not all in cash. So they basically have a balanced, well not balanced, but they have a portfolio of assets against essentially dollar liabilities. So they're trying to generate yield that way. I think the other one is all stablecoin companies will have to start basically acting as micro central banks. So they'll issue the stable coins, they'll take the deposits in to issue them, but then they'll actually become the lenders into the borrow lend market. So into the repo market themselves, into the crypto repo market. So, if you think about it, USDC, yes, is going to have to pay, who do they use? So they use BAML, right? So they're probably paying BAML 30 bips to hold their cash. Well, USDC should just go print all those USDCs or borrow cash, presumably at say 30 bips, print a whole bunch of USDCs, then go lend them out in the crypto repo market at 5%.
Yeah.
And that's a huge NIM. As a net interest margin, that's gigantic. And I think that's actually what's going to happen. I think the stablecoin projects, no, like it's not offensive to say, but it was a technology solution that now is going to enter into a banking solution. And these guys are going to be shadow banks essentially. And I think stablecoins overall will become in the next, I reckon 3 to 7 years, will become huge shadow liquidity pools. Like you look at already in China, already a lot of Chinese companies use tethers to fucking boost their balance sheet because they can't get hard US dollars. But, CZ says tethers are okay. So companies in China accept them as being okay.
Yeah. So the other thing that I'll add to that is as long as fiat and US dollars are still viable, they'll be there. But I think the move is with stable coins, and this is the second point I made when I was talking to them, is crypto collateralized and then algorithmic stable coins will probably start to move into the foray too, as you're already starting to see, right? Like DeFi is all about crypto collateralized stable coins, and that's where a lot of the money is moving into in the crypto space. So like everything based on Ethereum, there's crypto collateralized stable coins like MakerDAO, and then lots of others that are being built on different protocols and even on the Ethereum protocol itself. The one thing that has not been able to happen because they can never hold the peg is an algorithmic stablecoin. I'm really interested to see if that's actually going to be a viable solution. It has never been able to before. Nubits tried it. What's it called? The one Dan Larimer.
Yeah.
And they've all lost their pegs over time. But
who are the one that didn't even launch?
That was not Stasis.
Yeah, it was Stasis.
It was it Stasis?
Yeah.
Or Basis or something.
Basis. Yeah, the guys from DE Shaw.
Yeah, exactly. Well, they ran into problems where they couldn't model it without it being a security, so they couldn't make it into an algorithmic stable coin. So they just gave up and then gave the money back. But like those are the things that I find interesting as well, and those are really where we start to like look at things in a completely different perspective of a decentralized finance model versus a traditional finance model, and where things can start to like compete in different ways. Like, so one thing that's interesting in the DeFi model is, for people who don't really know about it, is that like, while we're living in this super low rate environment in the traditional world, you can collateralize and lend out your crypto and get a pretty juicy rate on it.
Yeah.
Obviously, the rate comes with risk, and that's why you get the rates that you do. But the point being, though, is that you can get some interest there that you can't get anywhere else in the world.
There's probably one good tip for users out there: avoid any projects called D-Force. Like literally, one of the they came up with it called Dick Force. Like it's like seriously, are you serious? You've called your project Dick Force? Like, but yeah, good for them. They got hacked pretty quickly. But yeah, exactly right, George. I think stablecoins will be huge.
Yeah.
I just. The concept's so far out of the bag now that you can just essentially move these dollars around. They're accepted. Basically, bank IOUs is essentially the way they work, right? That you just can't see these things going back away now.
Yeah.
Now that people recognize them and are happy to use them, happy to accept them. I mean, it's crazy. Tether now. Tether trades every day at 20 basis point premium.
It's amazing.
You can try to buy it on Finex at scratch, and that's difficult. But if you buy OTC Tether trades anywhere from 20 to 50 basis points over parity just because it's Tether.
Well, yeah. I mean, I personally hold whatever cash I hold. I actually hold in Tether now, just because. Yep. I mean, and even the on and off ramps have become so simple. I mean, thanks to you, Grant. But I mean, it has become, whenever I'm running out of cash. I mean, the other day I told you I want Tether. Sent money, I had it to my account. Same day, done. It's there.
Yeah.
I want to sell it. I assume processes. It's becoming easier to do that. So why would I want to hold cash when I can just hold a crypto version of that cash? And I can take it with me.
And the other cool thing about it, what you can do with it is then overnight, if BTC falls out of bed and it's down 25%, instead of that just being wasted, Aussie pesos like that would normally be sitting in your bank, you can just move that Tether straight to Binance, straight to us, straight to wherever, and have a crack at buying the market. And so you got that. It gives you that optionality as well. The fact that it's deployable capital very quickly, rather than it have to be locked up in an account.
But you also made another interesting point today in DAS when you were saying that. Yeah, you're holding that cash, and that cash is being held with somebody providing you lending. I mean, the lending rates within the crypto space are much higher than what you get from a bank right now. And even if it's risky, I mean, realistically speaking, you wouldn't want to go to a provider that doesn't have insured custody, that doesn't have, and as long as all those things are in place, I mean, what's my risk really? Even if you go bankrupt, I still get paid.
Yeah, exactly.
It might be a process, but I'm protected. I still get paid, and especially if they're operating in the US, Australia, Singapore, somewhere where they actually have regulatory bodies looking over them.
And you should always, on those things as well, I mean, like, BlockFi, Nexo do it, but any other providers, like with us, like we don't have such a beautiful UX like they do, but we'll send you a proper PDF electronic copy of a loan agreement that is a piece of law recognized in the state of New South Wales, that
just like a bank would give you.
Exactly. And if we stuff up, mate, we're all Australian directors. We're all
you have
Australian
financial
investors.
license.
So, so you can come, it's an actual thing. We actually worried about being sued, so we're not going to do stupid stuff because that's what we actually care about. But, that's what people should be looking for. And then if you're going to do, to do non-custodial smart contract stuff, like what George is talking about, I really like those solutions, and I think there's some really good guys out there doing some really great solutions there. Just, do your own research, understand, is the code spaghetti or not?
I like them too. I just think they're too experimental at this stage, and I think more it's baby steps. If we can slowly get people to tether, then slowly we can explain decentralized versions, then slowly we can get there. So a question from Oliver. So what Oliver's saying is that at the moment you can take money out of your super account, apparently.
Yep.
10K per financial year. So what stops somebody from taking that 10K and putting it back into their super and then saying that's a tax write-off because you get a 50% match from the government?
Without being a tax agent and providing taxation advice, Oliver, I do know people who are actively doing that trade and other sites of trades like that at the moment.
What he's saying is the only downturn he sees is that if they find out, they'll just tell you this is not allowed. Is it anything more serious than that? I mean, again, no one here is a lawyer or an accountant.
I don't understand. Where was the trade?
So you basically, George, what you do is you take out, you can cash out some of your super at the moment.
Up to 20K.
And you cash out and you basically just put it straight back in.
And then it's a tax write-off.
Rules, I know guys who are doing it for sure. Yeah.
I see.
Yeah.
And then take the 10K straight back out next year.
Yeah. Yeah.
Well, if it's still open, then because you're 20 grand in tax write-off.
Put it into Bitcoin.
It's not bad.
What a time to be alive, huh?
Yeah. Yeah. I mean, it's not as generous as our glorious government gave, everyone who was over 58 a couple of years ago, where you could just put in basically unlimited money just before you retired and put in at 10% instead of your marginal tax rate. It's not quite that good, but it's something.
Yeah.
Chris, I have something for you from the crowd. So what they're asking is that what are the effects of all these issues we have globally on FX in emerging countries, Southeast Asia? I don't know what these currencies are. PHP, THB. I think it's Indonesian. Yeah.
Yeah. Not the Aussie one, Omar, the real one, Filipino.
Yeah. That's what. PHP is Filipino peso. Okay.
Yeah.
And what's THB?
Thai baht.
I think
Thai baht.
I tend to focus more on major currencies and G10 effects, to be honest, more than these ones. I mean, I talk to clients a lot about if we want to go into EM, Real and Mexican peso.
So why do people do that? Is it because it's more money to be made trading it? Is it like buying shitcoins on crypto? Is that the reason they do it? There's more gains,
much.
more.
Yeah. So with EM currencies, the problem you have is that they can be incredibly volatile, or they can be more volatile. And when you're trading in 200 to 1 leverage or whatever the ratio that your broker is providing you, when you see these moves, they can be very punchy and adopt massive leverage to that as well. They can trend very nicely if you're a trend trader. Some of if you have a look at the chart, dollar Brazil, there's been political risk recently in Brazil that's caused some big sell-offs coming through there. But it's not everything that's working. It's not a rising tide lifting all ships at the moment. So the Mexican peso, for example, would be quite closely correlated to what's happening in crude. It's a big crude producer. So if you see the WTI price moving up quite sharply, you can see the Mexican peso do quite well. You get all sort of political issues playing through, and we've seen some decent sell-off playing through in the Indonesian rupiah. That's come back really nicely over the last couple of weeks. And then you've got the strong dollar policy as well. So if the dollar's strengthening, EM currencies do pretty poorly because everyone focuses on the fact that these guys have borrowed, so much debt and then have such massive US dollar liabilities over the years. But I think there's been a big breakup of correlations amongst the EM currencies recently. that you don't really focus on that so much. I mean, I still tend to focus on the Mexican peso, the Brazilian real, the South African rand, and the big boys rather than going into the other ones. Because what happens is, if you start getting into the Indian, Indonesian rupiah and some of these guys, the Malaysian ringgit, is that the spreads just become really it becomes really expensive to trade these currencies. And liquidity is less prevalent. So I would stick to the majors, and I stick to the stay to the bigger end of town. Otherwise, it gets quite expensive to trade these.
Fair enough. Okay, so back to AUD and USD. Just basic question. So what I'm getting from our conversation today is that it's the US dollar becoming stronger more than it is the Australian dollar crashing. Am I correct there, or have I got the message wrong?
Well, at the moment, as I say, the Aussie dollar is moving very, very closely. There's a very strong correlation between the Aussie dollar and what's going on with equity markets. And so it's kind of got this row kind of risk on, risk off thematic playing through. So when the S&P falls, the Aussie dollar falls. Maybe slightly different deltas to that situation. So yeah, I think if you're taking a view in the moment where the Aussie dollar is going to go, it's really used as a vehicle to express risk and the feeling in the backdrop going forward, rather than anything to do with what's happening in the Australian. So if you think that the equity market's going higher, then you go and buy the Aussie dollar. If you think that they're going to roll over and we're going to see them go low, that's
okay. Since that's what we said, this is a question to all three of you. Where do you think the equity markets are going? Like, I can see them right now coming back to green, but are they is it just bull traps and we're going back down, or is this over? Are we going full green again, like nothing happened?
So I'll go first with my prediction, I guess. So look, I mean,
don't give me basic stuff I hear on Twitter. Give me alpha.
Alpha? Okay. Alpha is don't fight the Fed.
Don't fight the Fed.
No,
okay.
Like they have told you what to buy. Buy it. I mean, I'm not saying that we're going to all-time highs. I don't think, will there be corrections in here? Sure. But I think there is definitely a deep support in the market, and that support is super strong. We've seen that support for the last 12 years. Now, the only question you have to ask yourself is, can they do it again? And until proven otherwise, you have to believe that they can and they will. So let me give you an example. From like 2000, after the GFC, right? Like the markets bottomed in March of 2009, but like the policies of like quantitative easing and a lot of the other policies that the Fed didn't really start to take hold in the market for a long time afterwards. Like the markets didn't really start to rise dramatically and get above key levels for a long time. But there was a bid in the market that you would see every single Friday or almost every day, where like if it was getting near key levels or like around 3 p.m., suddenly there would be these mystery buyers that would come in, and like they call them the plunge protection team. And the reason why is they stopped the bleeding. And it was there in the market, and you can see it all the time until the market actually self-fulfilled to a degree and started going up on its own merit, its own steam. Job market started to grow, like whatever. They helped with the cycle, but they backstop, and they have the ability to backstop. Now, the only reason to bet against that and say that this time is different is if the backstop doesn't work. So far, it has worked really well. Look where the markets are. And despite the fact that everyone keeps on saying we're going back to test the new lows, it's not going lower. So for me, what does that mean as a trader? I mean, this isn't alpha per se, but like I sit on my hands here because like I don't know where we are. We're in no man's land, really. Like we're somewhere between like support, resistance, but also just like in a market where I'm not really sure of what I would be buying and why here. But I do know this, like right now, you can't bet against the Fed. You can't take a position here. No position is a position. That's alpha. And that's the alpha I'm giving you.
The way I see this is that you've got the systematic guys who look at the US economy and say, we don't care. We don't give a shit about the fact that this Friday we're going to see 21 million job losses. They could give a monkeys that we're going to see the unemployment rate at 15%. They buy because the market's going up, right?
Yeah.
And if we ever see the VIX below 20%, we'll start seeing the vol targeting funds create a new wave of capital coming in. We've also got a lot of the CTA guys, the commodity trading advisors who follow trends, and you know, they've flipped to a more neutral position. They've started buying, and we'll see going to a much longer position through 3,000 on the S&P. So a lot of what's actually happening is to do with systematic guys who couldn't care about valuations, guys who couldn't give a monkeys about economics. They're buying because the Fed are promoting liquidity and the market's going up. They're buying because the market's going up, and that's what, you know, you guys as technical traders should be doing as well. So through 3,000, you know, you get an extra wave of trend following, you know, CTA capital. If the VIX was to go below 20%, you get then markets going to all-time highs on the idea of vol targeting funds coming in. To you and I, like to me as a discretionary guy, I'm looking at the S&P at the moment, and we've had this big move down in earnings for this year, and we've had about a 15% decline in earnings for 2021. Everyone's written off 2020. This year's done. It's shit. It's going to be horrific. Let's look at 2021. Okay, well, let's look at next year's earnings. They're down about 15% through this earnings cycle. But the market's still trading on 17.5 times forward earnings for 2021, which is pretty expensive. This year, if you look at full year earnings for the market this year, for the discretionary sort of traders out there, we're trading on 22 times forward earnings, which, you know, if you go back to the dot-com era, we got up to 25 times. So we're not a million miles away from those levels. So a lot of mum and dads out there are sitting there going, oh, you know, the market's trading on 25 or 22 times forward earnings. I'm not going to be buying that market now. It's really expensive. Next year's earnings 17.5 times, end of the credit cycle. Plus, we've got an economy where, 15% unemployment. How can I buy markets? These people aren't even in the markets. They're still de-risking. The guys who are buying at the moment, they couldn't give a monkey's about any of this stuff. This stuff means nothing to these guys.
Exactly.
It's just the market's going up. The models are telling them to buy. There's no emotion involved in that. And so what's going to cause this market to go all-time highs? It is down to positioning. It's positioning and systematic flow. And that's something that a lot of us just don't have access to or even really truly understand. The sell-side banks see that flow going through their books and they tell you about it and they tell some people about it. But I think that's where you go. You're going to be left with a market at all-time highs, and that divergence between the economic reality, so companies going out of business, you know, big recession, but yet the market all-time highs. And that's just something that a lot of people just can't reconcile. It's quite a bizarre concept.
This is why, looking at key levels in markets, whether you want to call it technical or analysis or not, is really important because, like Chris said, there are levels that everyone's looking at and watching, and the trend followers are all there. And right now we're kind of in between those levels. That's why I say sit on your hands, because right now I can't make a decision based on it. I need to see something happen, a break to the upside or to the downside. And right now it's just sitting somewhere where it's really hard to navigate. Like buying here is just like basically pulling and praying, right? So like following key levels or having some kind of trading plan of some sort that like you're going to use, not just buying off the cuff, is super important. And like everyone,
I can give you the levels now. I mean, you've basically got the S&P, the cash market. We look at the futures, but looking at the cash market through 2,800, yeah, you'd probably say that you've got a case for the market to go a little bit lower.
Yeah.
But you go through 29.54, which was the swing that we got on the 29th of April. I think the market goes into the 3,000. That's when we start seeing the CTAs going really net long. But you've also got, just at that level, you've got the 1,003, and you've got the 100-day moving average slightly above that. Market trades through there, and you're just going to get more systematic flow going into the market. Then we see 3,400, which is the all-time high coming into play. So, you know, it's not about the discretionary guys. Like Warren Buffett came out on the weekend and said, I've got 120 billion that I want to invest, and I'm not seeing any value in the market. These aren't the guys putting money to work right now. It's the hedge funds who are buying. And they've you've seen some of the returns that you're seeing in the hedge fund community. They're absolutely outstanding in April. You know, these are the guys who couldn't give a monkeys about where economics are. They've seen liquidity. Like you say, George, don't fight the Fed. Liquidity is the oxygen in the market's lungs. And when the
Yeah.
market's lungs are feeling full, you're going to go and buy. So I think
And
repositioning is the key.
And in saying that, like, and this is just my opinion, but I think that we all share it here, is like, go and buy anything, but just understand that what you're buying, there's no value in it. It's probably at a super high level and can go higher. Just don't be married to it. Sell it. Because there's no reason to be holding a lot of this stuff. But like, the only reason is because it will go higher. And it's not because of any economic reason, like Chris said. There is no economic reason for it right now. But that doesn't matter. You can still make money.
When it comes to economics as well, people are, the markets are all saying, they're all looking forward. How far forward are they looking? And they're looking at economies that are opening up. A lot of these restrictions which have been rolled back, and they're looking for demand to kick in again. The inflation guys are arguing. They're saying, there's a lot of stimulus in the system, money supply is ramping up, and we're going to see demand come back at some stage. I'm not so sure, and I'll take the other side of that trade personally.
Yeah,
I think that bonds at the long end are still actually, over time will continue to come down. I think we'll see a flatter curve. A lot of people would disagree with me. Whatever, that's fine.
There's no reason to fight against the bond bull market. It's still continuing right now. But like, the other thing I'd say too is, and like, this is a thing that I laugh at a lot, but it's only because you're experiencing the markets. But like, people are always in disbelief. Like, they're like, how could the economy be so bad and the stock market can continue to go up? And like, people just don't understand that the stock market and the real economy have absolutely nothing to do with each other. They never have, and they never will. And especially now when there's this much liquidity in the system, like the stock market used to be a leading indicator of the economy. That's not the case anymore. It's its own. I don't even know what you would call it, but like it's basically been designated as the only place to make money or to have a safe. It's almost like a safe haven now of something that's always going to go up. And until that's proven otherwise, I mean, that's the game in town. So, I mean, it's hard to fight things like that.
There's a question here about stablecoin. I'll take it back to the Bitcoin. I think question for Grant. Do you want to ask that one?
Mate. Yeah.
Why can't I see the question? Oh.
From Kit. I mean, how stable coins, they're going to be more widely, unless the exchanges that issue them practice fractional, more widely used. Well, I think that's exactly what will happen with stable coins. I think they'll just operate as per any other form of dollarized collateral, and you as the counterpart involved in that transaction have to form a view on the value of that collateral in case you need to rely on it, and also the likelihood of the counterpart on the other side actually paying you back. But yeah, I think absolutely that they're already, Tether's obviously fractionalized, the others not yet, but I can't see that not becoming a thing.
Yeah, I mean, you're already starting to see that in other areas like rehypothecation of Bitcoin. So I mean, you have to, it's buyer beware in a lot of this stuff, and you just need to understand what you're getting yourself into. I just find it challenging personally when I start to see recreations of the traditional financial system in the crypto system, but that's inevitably always going to happen. But the beautiful thing about crypto is that you actually have choice to decide if you want to use those kind of products or other products. So for example, when we're talking about the DeFi stuff, like a lot of that stuff, it doesn't have those types of issues yet. It may not, but I don't know. Like the thing that we talk about a lot in the space is like, let's not build what already exists. And sometimes we come dangerously close to that. So I'd like to see like the ethos around some of this stuff be more true to form of what crypto is supposed to be about. But unfortunately, like when it comes to making money, financial engineering goes where it wants to go. So you just have to kind of like understand what you're buying and understand the products themselves. And I mean, like, look, a lot of this stuff is really complicated. Like that's another issue. And it's not just like you get that in the traditional system, but you're getting it in crypto now too. Like the UIs aren't great. Like the products themselves, like trying to explain them to grandma or grandpa, it's a hard sell. And you know, I always think you need to keep things as simple as possible, and that includes like, you know, a lot of us will say like asset backed, like things back to gold or things back to hard assets. Keep it like that. It's a better money system, but you know, that's just not how it always works.
Since you're talking on hard assets, I actually have an interesting question here. It's like, what's the likelihood of a government confiscating private assets like crypto or gold and making it illegal to actually own it like they did before in 1933? Just when they removed the standard, I assume.
Yep.
Yeah. So what are your thoughts on that? What if,
always high likelihood.
My take on this is I was in China when they banned it and they couldn't stop that. And if the Chinese government can't stop something, nobody in the world can. But maybe you guys have a different take on it. And I'm biased towards crypto, towards Bitcoin and crypto as well. So yeah, I'll let you guys give your thoughts on that.
We're in a fiat money system. And if there are inherent risks to that at some point, which haven't been deemed highly risky yet, certainly you could see that stuff get seized.
Even on gold, if I had gold bars at home, can they just decide they need to be seized and they'll come to my house and take my gold bars?
Well, yeah, they actually did. So that they didn't do that, but they deemed physical gold was illegal in the US.
And what happens to that when it gets taken? Where does it go? The government just takes it?
Yeah, they put it in their vault.
Interesting. Who's doing their custody for them? I think that's a good business.
Self-custody, mate. Self-custody.
I think that idea is just it's not going to happen.
Nah. Yeah, it's not good. If that happens, I mean, I keep saying people are very soft and nobody's hot-blooded enough. Everyone's so calm about this. You should be in the streets rioting. But the second they do something like that, you would expect people to actually, we cannot be that spineless that we just let them do that and sit down at home and be like, okay, cool.
Just feed them bread and crumbs. Just give them bread and crumbs, man.
I've been looking at silver thanks to Will from Mining Store. By the way, guys, I'll put in the Discord channel in the chat now. It's part of the Mining Store channel. It's Whisky&Wicks. I'll just put the link now. But Will got me kind of thinking about silver, and I was looking about it the other day, and I mean, silver is reasonably priced. So I was trying to find somewhere so I can buy physical silver. And it seems to be essentially impossible, or I'm paying a ridiculous premium. By ridiculous, I mean an ounce of silver is about $25. They want me to pay $78. Yeah,
I don't know. I don't trade physical silver for that reason.
But with that, I would assume the reason for that happening would be not trading it, just buying it physically. But I assume the reason for that is a lot of people are doing this. Is it just a demand thing nowadays that everyone wants physical and we're just running out of it?
Oh, I don't follow the physical markets, whether it's gold or silver, that highly. I've seen, a lot of these American Eagles trading at well over 2,000, and I think that's the same in physical silver as well. Whether it's storage costs, whether it's just the transport costs to get it to places, whatever it's going to be. I work on the CFD front, so our clients don't want to own our clients have no interest in owning the underlying. They just want to make a bet.
Fair enough. My justification for it was just same way I thought about it. I assume a lot of people did and just created demand. I just thought there was more to it than that. But yeah, that's fair. Okay, so but even on the likelihood of confiscation, I really think that confiscating crypto, for example, is a much harder thing to confiscate than gold or silver. I mean, at any point of time, how can I possibly know how much crypto any one of you has? Unless you're running around sharing all your wallets to, but I can realistically have 100,000 wallets right now and nobody would know. And they do say that about crypto a lot. A lot of the guys that have a lot of Bitcoin, nobody knows they have that much Bitcoin because that just makes them, that puts a massive sign on their back, come rob me.
Yeah.
DJ has a question. So DJ, this might be one for you. George, DJ is asking about Ethereum. He's holding BTC only at the moment because I've been brainwashing him. Should he be moving some of that into Ethereum? I think the answer is yes, you should be, but I'll let George answer.
I don't like to. I actually don't like to like say yes or no.
Okay,
but
this is not okay. Not financial advice. And in your situation, if you had 10 BTC in your portfolio, what would you do with it?
Okay, so I'll give you compelling reasons to own Ethereum, and I'll give you compelling reasons not to own Ethereum, right? So like Ethereum has the biggest developer community of any blockchain community in the world, and that has not ceased, even though there's been all these quote unquote Ethereum killers that have come into existence, and none of them have even come close to getting the same adoption or usage as Ethereum. You have things like Tether moving to the Ethereum blockchain. Ethereum's transactional volume is higher than Bitcoin's. You have Ethereum moving to proof of stake and scaling, which
that's a negative, not a positive.
No. It's not. I'll give you the negatives on that as well. It's a negative and a positive. Okay, so the positive is that it's going through, and in July, phase 0 happens where they move to proof of stake. There's consensus, or at least excitement within the community, that they'll be able to start the implementation, and that it'll work well. DeFi is taking off left and right, and most of that is built on top of Ethereum. So that's lots of money that's getting locked into Ethereum. And the other thing I should talk about with proof of stake is that once that's implemented in July, there's going to be a lot of that Ethereum being locked up in proof of stake. So from a supply perspective, there'll be less supply. So what are the negatives?
When's that happening? When are they moving?
July. Phase 0 is in July. It was supposed to be in May. Let's start with the negatives. The negatives are that the targets have been moving for a very long time on getting Ethereum 2.0 up and running. There's been talk of there's been disjointing of the Ethereum Foundation. So, who's running the show and how are they going to get this implemented? There's still a lot of doubt around. There's going to be like a one-way peg between different coins, which is something that's a little bit questionable. People are talking about, but the main problem is not moving to ETH to phase 0. That will be done easily. It's the sharding, which is next, which will give scalability, but all the other stages after this. Can they actually do it? And they're going to do that separately, and then try and bring Ethereum, the blockchain we know now, together with the other blockchain. There's a lot of risk in doing that. I think like if we're going to get a market that's up in crypto, it's going to be led by Bitcoin and Ethereum. But longer term, there's still risks in Ethereum. More so than in some of these other projects which have already built out their blockchains from scratch. But the thing is, though, like until you start seeing like lots of developers moving away from the Ethereum project, like openly questioning Ethereum versus other blockchains, which you really haven't seen, to be honest with you, even though people have all these high claims about how great all these other blockchains are, no one's using them. I think like Ethereum, you need to put some money into it. Maybe not as much as you would Bitcoin, but it's definitely the most usable, the most adoptable, and by far the blockchain that is probably paving adoption, if not as much as more so than Bitcoin at this point. So I'm pretty bullish on it, but I'm cautiously bullish on it. I think there's a lot of near-term bull catalysts. Getting the technology, to work right over the long run is certainly risky. I wouldn't even know how to even qualify an answer to that right now. I'd say like though there is definitely near-term catalysts, which I think will be price positive.
Okay, that's interesting. I mean, even myself, DJ, I mean, even I've bought some Ethereum lately just because I don't think, like, you might want to think about it. Ethereum was just under $200. What is it now? 200, 220? If you
don't believe in Ethereum and what Ethereum's doing, then you don't believe in crypto. You just buy Bitcoin.
So that's the thing. I don't really believe in half that stuff. But from a trading perspective, if you do believe a bull run is ever going to happen, Ethereum will be leading that bull run. That's just how it is. It will be that way. So it just, it doesn't make sense if you're getting exposure to a bull run and not just hoarding it up, that you shouldn't have any Ethereum. Even the Ethereum killer plays, I mean, that's good validation for all of us from a psychological level, that everybody claiming to be an Ethereum killer and then knocking on Ethereum is essentially saying Ethereum is the holy grail. Otherwise, why would you want to kill it? And just basically at that thing is just... Tezos to me is one of the ones that I've been accumulating, waiting for my Tezos moonbag.
Another proof of stake coin?
Yeah. I got into the ICO and I'm still holding my coins. I'm just hoping we'll do 100x in one day. It's been like 4 years. I think I deserve it by now.
You do. And you deserve a pony as well.
Can we have this shill session again at the end, or?
Duncan's not available this week.
We can show. I mean, what was it? Chainlink just. I mean, I started buying Chainlink again for one purpose only, because they came up and they're like, all the smart contracts are going to be built on Tezos are going to be done through Chainlink. Now the thing is, just from a perspective of a trade, those two communities are so toxic and so big that they're not gonna they're gonna pump it and then dump it. And that's something I'm willing to take a trade on, exactly like EOS, where I was like, I'm happy to write it up, but I know it's going back to zero because it's just not right. And it didn't work. Let's see, what else do I have questions? No, I don't have any more questions. Anyone have any more questions, guys? Jake wants to come on. Let's get Jake on. Hello, Jake.
Hi, gentlemen. How are you?
I'm good.
Mate,
I think you were on last week, right?
Yep.
Yeah, a couple of weeks ago. Yes, absolutely.
Welcome back.
Thank you. I've got a question, something I thought was really sort of fascinating. There was a lot of companies in the US that were looking around synthetic assets and how you break down, particularly things like real estate. This was sort of around the early 2017 period when all the conferences were taking place. It was a really hot topic around what sort of assets could you tokenize. And that was very much a conversation. Tokenize everything, tokenize the world, raise money. The ICO craze obviously was part of that, but more importantly, the underlying message was around this tokenize everything. George, in particular, I noticed that you are following Synthetix on Twitter. And so I assume that you're probably familiar with what they're doing and how they're doing it, and the fact that they have Australian leadership in Kane as well. What's your opinion on that as a platform? And, I understand that there's an obvious tie-up with what they're doing with Chainlink, but how do you see synthetic assets and smart contracts evolving beyond just what Ethereum does as a protocol layer?
Yeah, so I mean, what they're doing is really interesting, and I think it's one of the best projects out there, to be quite honest with you. So the reason why they linked up with Chainlink is, I don't know if you know the backstory, but they had an exploit about a year ago where a lot of Synthetix got stolen, lost, whatever, exploited, because there was an Oracle problem. So Chainlink is, I'm not shilling it for these guys because they all love it, but Chainlink is the solution that most people are going with to solve their Oracle problems, right? And that's something that's growing, and they have lots of customers. So Synthetix is really interesting because it's moving out of the sphere of just crypto assets into traditional assets. So you can, make S Apple or S Gold or whatever. You can create synthetic assets. So I think that is obviously the next frontier. And what's interesting about what they're doing versus what was happening in 2017 is back then it was more there was people talking about synthetic assets, but there's also people talking about tokenizing assets. So the security tokens of tokenizing real estate and them being able to distribute out, like make it into like 17, 20 people owning a house or owning a piece of real estate and getting distributions off of that. This is actually the real synthesis or synthetic. This is the way that you really synthesize assets, and it's derivative play, right? And I think that they're one of the more interesting plays out there for sure. And I think that their market share is only going to grow. Kane's very innovative, and he's been launching a lot of new stuff lately, which I happen to like. So I've been writing a paper that I'm about finished on DAOs, right? And a lot of it has to do with like companies that are becoming DAOs, they're decentralized governance models, but also the incorporation of like DeFi into decentralized autonomous corporations or organizations. It's just like a natural fit, right? Synthetix has turned themselves into a DAO, and the thing that's really interesting about a lot of this stuff is it's like you had the blow up with MakerDAO, right? Like what they're doing is Compound's doing the same thing. They're opening it up kind of to the community to vote on like the software protocol upgrades, what they want to see, the parameter changes, and all that kind of stuff. And like for me, I think that this is like the logical progression of decentralized finance and decentralized governance. And that's why, like for me, like, going back to the whole Ethereum play is like, this is where all the innovation is truly happening right now. I mean, Bitcoin's starting to catch up and looking to do things with DeFi and integrate like different things into it. But I don't like that. I think Bitcoin is what it is, and it should just stay what it is. Bitcoin is money. Bitcoin is a challenge to sovereign money systems and every other type of money system. The rest of this stuff is very different, and it's really about programmable assets and using technology to make these assets programmable. And obviously that means that Bitcoin is starting to be incorporated into the Ethereum world, which is awesome, and vice versa may or may not happen. So like you're getting synthetic Bitcoin as well, that's on there and all this stuff. And I think like for me, like I know Kane, and I think that project's really good.
And just sorry, one quick question on that. I'm not sure how familiar you are with the platform Robinhood in the US.
Yes, I am.
Yeah, right. So have you used it or seen the UI in there in the app?
Yes.
Yeah, right. So you understand how slick it is, how easy it is to use,
exactly.
how easy it is to.
Yeah, I actually have Robinhood. I don't really use it, but I had an account there years ago, so I've used it, and now they've incorporated crypto into it. Yeah,
correct.
Yep.
They're also fractionalizing normal shares, so that's a fairly new offering. And so I think that's interesting, and I do wonder if Synthetix keeps on the track, and they're talking about sort of some of the UI improvements they're making. That was a big hurdle, and so where E-Trade and Charles Schwab and all these other big trading platforms in the US, Robinhood started eating their lunch because they just were able to onboard millennials in trading stocks, introduce them into crypto as well, but just the on-ramp there to get people into taking control of how they invest and some self-custody in there theoretically. But that I wonder whether that type of a play, that type of integration will be what brings it to the mainstream in Australia if something like Synthetix goes down that path, acquires a banking license, and is able to onboard some of these people in that manner. It would be very interesting.
Yeah, or vice versa. You could start to see mergers and acquisitions between traditional finance and potentially some of these platforms. Although I think it'll be a lot harder to do that because of the money Legos piece, which means that a lot of these platforms use other platforms at the same time. So it could be difficult. But like you would think that like as you start to see like the fractionalization of these assets on platforms like Robinhood, obviously there's technology solutions that can be done to innovate in the traditional sphere, like you're seeing in the DeFi space, and that can actually help to retain some millennials who prefer cryptocurrencies and digital assets over traditional assets. One of the things that people have talked about for a long time is that like you couldn't fractionalize shares, right? Like that. You could like that stopped being a thing a long time ago, and now that they're bringing it back in, it's really interesting, particularly for things like Amazon or Google. If people want to own like a small fraction of it or something, so I think that's pretty interesting.
Guys, we're going to kind of start running out of time, so I have one question that's for you, Chris and George. So last time we spoke about oil, how it went negative and all that. looking at at oil over here, what do we think of, and how is that going to impact the market? And is there a potential for us to actually see a repeat of what happened last time?
Shall I go first?
Yeah, you can go first. You can probably pull us up a chart as well.
I've got a chart here.
Yeah.
This isn't really about the repeat of last time, but the thing that I always look at is the curve, the futures curve, whether you're looking at Brent or WTI curve. And I think what's really interesting, I go further out the curve to where all this kind of storage madness is happening, as people paying refiners, to take oil off their hands and all these various factors. And I always look at the fifth contract, right? So you're going further out the curve into the area where the demands were supposed to kick in. And have a look at this relative to the S&P, which you've got the blue line here. So, oil has been working quite nicely here. So you've got this period here where the fifth contract takes a dive. Takes a while. I mean, causation and correlation, all this kind of nonsense. But you can see the S&P obviously coming down here. That was obviously nothing to do with the oil market until OPEC came out and pulled the pin. And then you've got a situation where the fifth contract made a nice move up. S&P moved up slightly afterwards. We're now starting to see the fifth contract moving up. So I think, take out storage out of the initial situation when we get the rollover coming through in a couple of weeks. The fifth contract's actually started to move up a little bit higher, and you're probably going to see convergence with the S&P there. And I like that situation, so you are seeing a really nice little double bottom playing through. And if this continues to go higher on the fifth contract, when you go further out past the near-term madness that you're seeing, then I think that would be probably a bit of a positive for risk assets more broadly. If you have a look at the curve, you've got the current curve here, which is this orange line relative to where we were a week ago, and you've seen a lot of that contango coming out of the market. So the near-term contract, the June contract, the July contract, the September contract, the August contract, it's certainly lifted quite nicely. We've got a slightly more flatter curve compared to where we were recently. But I think you've got a lot of the supply issues out of the market. We've got peak supply. OPEC are cutting back. The US shale guys are coming back. The rig count's been dramatically cut back, and we've seen a really nice move up, as you can see here from the curve. As I showed there from the chart, there's been a big divergence between the S&P and the further dated contracts, which doesn't have that madness that it has when you get to the roll situation. But I do tend to think that there's not a huge amount more upside from where we are, because I just don't think the demand's there, and I think you've probably seen a repositioning from a lot of the ETF funds. People have been focused on EuroZone, where they've moved their holdings from front month, purely tracking front month. They've got about 15% of their holdings in July. They've moved them right out to the curve into 2021. And a lot of that overhang has taken out of the market now. So the big oil tracking ETF funds have moved their holdings further out the curve and tried to smooth out their returns. And so a lot of that false selling's come out of the market, and I think that's been really good for the oil market as well. So I think the easy money's been made. Not that it's been easy money, but I think we're getting to a point now where we've got to a much more equal situation. So it's going to be hardwood to chop much higher than this. But yeah, really nice market, really nice move. I struggle to see huge upside here from the oil price. George?
Okay. George, thoughts?
I agree. I don't see much upside either. I don't think that there's much else that I can add there. I mean, he's pretty much nicely said it all. Obviously there's massive storage issues, and those aren't going to be solved anytime soon. So again, it's a demand thing.
You can see here that the open interest in the June contract now, everyone's focused on the June contract, but the open interest now has gone up to the July contract. So whilst June is still front month, all the funds have moved over to the July contracts. The July contract's where all the open interest is. If you are trading June as a futures contract, the obvious level is you're getting up into these kind of $30 marks. You've got the 50-day here. You've got this level of previous supply coming into the market. Price action's not overly prolific, but I think the active funds now have already, probably a lot of them have already rolled into July. That's why, as I say, the open interest. See the future market here.
Okay.
So there you can see. Look at the open interest now. This is where all the open positions in that month. So July, 378,000 net contracts there, and you've got So really, whilst June's still the front month, July is where all the big funds are playing around now. That's where they're all messing around at the moment. So you've got to look at July. But it's been, oil doesn't mess around. It's not 1-2% moves these days. It's 15% moves. So, if you're dabbling around in the oil market, you've got to have, you've got to have wider stocks. You've got to take your position size right down, of course. And this is why I look at implied vol, because implied volatility it's come down, substantially, but it's still pretty high. And when you're getting 15% moves in any of the contracts, then that's one for the bravest of souls, in my opinion. So. Especially when you add in leverage. So I don't really trade oil. I like the petrocurrency. But if you get offside on the oil market, it can be a really nice move, or it can push you a shirt.
Okay, it's a fair play. Let's close the share screen. I'm just putting up another poll. Any other thoughts, Grant, George? Any?
Well, mate, I think we'll just continue to see lots of volatility. Obviously, in the next couple of week or so, into the halvening. We're just seeing that at the moment. Bitcoin's been trading that continuous 3, 4, 5% range, which is pretty crazy. Traditional markets feels like everything's just getting a little bit quiet at the moment. There might be a bit of jubilation and a upside move if some rollbacks happen or get announced sooner than expected, but that sort of still doesn't look like it's going to happen that quickly. So mate, I think it's all on the halvening. It's all about this Bitcoin volatility. This the market's just ping-ponging around $200 pretty much constantly, so it's pretty wild.
Yeah,
I see. Since we started the show, the price is up about $250.
Yeah, I had the chart up before, George.
Bullish.
Yeah, it's because it's because I'm back at trading, so I'm pushing the volumes up for you guys.
Yeah.
Sorry, I've been engrossed in chats and I haven't been paying attention.
Just ticked through went through 9,300, and then traded all the way back to 9,200, but now 9,240.
I mean, 9K was the key level. So if it holds here going into tomorrow, 2 days in a row over 9K, that's a good sign going into the halvening.
Yeah, we got rid of that. I think we had a shooting star a couple of days ago when we had that ugly close. And now it's that's
guys are still. Just 1 second, Grant. Sorry, guys are still on the viewers. Can you please answer this poll, as it's actually pretty important to me? You can continue, Grant. Continue talking to the panel. That's fine.
Well, I think coming back to George's point, I think also we got rid of that shooting star that we had, which was pretty ugly. So, it sort of seems like it should be all friggin', all systems go.
Roses.
Gents, I'm gonna have to call it a night. I've got to be up at 4, so
All right, mate.
Thanks.
Understand. Thank you very much, Chris.
Minutes more, but thanks a lot for coming on, Chris.
Cheers, brother.
We learned a lot from you. See you in the next one. So, crypto guys.
That always reminds me of that scene from Wall Street. Markets never sleep, bud.
This is an important one. So, the halving is literally next week. Please share thoughts.
6 days from now, actually.
Yeah, what are the thoughts on that?
Win $1,000 on Mind Digital if you get the price right.
Thoughts as far as what
I should have told me about this. Guys, there's a competition. Mind Digital's running. They'll give you $1,000 in Bitcoin if you can guess the exact price at the time that block is halved. Also, I need to share screen and show you guys something pretty cool that I was asked to share. Let me just open it. I just think the way people think of the halving is naive, that the second the halving happens, automatically we're going to see a pump or a dump. It just can't work that way because it's not really, it's not Justin Sun saying, I have a piece of news for you.
Yeah, I don't know. Like, I don't really plan on trading too much around it. I'm holding spot. I think there's going to be a lot of fuckery, and I'll wait until a little bit afterwards to make some decisions. I mean, like, even like, you know, looking at the options, you know, the implied vol's up in the calls now a bit more than it was. So it's hard to even, like, I don't know. I'm staying. I stay on the sidelines for this kind of stuff.
Yeah, it's been a tricky thing to play. Like today, for all money, it made a move right up to like 90, and it looked like it was going to just blast through for sure. And before you know it, it's just, you know, it's off $100 and looking terrible, and then it just, you know, grinds, and we get this, you know, jumps up. I saw Juice obviously this week, mate. You'd had a few, you know, trades up on Twitter, and yeah, I sort of felt you like what you're looking to do, I think, were the right trades. But yeah, it's a tough environment when it moves this much and really quickly, like 5-minute candles, and it's moving $100. Like, yeah, that's if you get it right, that's fantastic. But otherwise, yeah,
Grant?
it's pretty painful. Here it comes. I love this one.
Sorry about that.
Music.
I don't hear the volume.
Yeah, turn it up, though.
Let's get some music.
There's nothing I can do to make the music come up. Sorry, guys, that messed up. So I'm just gonna share the link in the thing so you guys can see it. I can't.
Keep it playing though. It's still worth playing. Yeah, there you go.
Up in the club.
Since the lockdown happened, the meme game has been ridiculously good. It's been on point to a level that we can't. I can't even think about. I mean, I just did a poll just to find out what people are interested in, and most of it I got was people understand economics and big institutional traders. So I guess for you guys, I'll tell you from now that one of the guests I have next week is an institutional trader that trades crypto. The position sizes he trades would be the average person's home equity value. Yeah, big trader from traditional world moved into the crypto space, and we can be grilling him next week on that. I also have an economist coming on next week whose role is more around global economics, global economic growth, sustainability around that, and how crypto and these things are going to be the basis for that future world. So yeah, I'll send those out once they're ready, sometime next week. Other than that, hope you guys enjoyed this. Thanks a lot for tuning in. If you guys have any feedback, even if it's negative, if you guys think I'm shit and we should get a different host, happy to do that. Just reach out to me, give me your feedback. Let me know what you want to see more of. If there's anyone specific you want me to bring onto the show, also let us know. We can probably get them onto the show.
This surely's got to be the meme for this group, right?
That's what did I tell you? My Instagram, my Twitter, my LinkedIn. These are my 3 completely different personalities.
Yeah.